market because we have a very tight labour market in this country. I mean, it's interesting that there's a lot of evidence that the economy is slowing. There's some evidence now that labour demand is beginning to slow, but we still have a very tight labour market. We've got a smaller labour force today than we had immediately before COVID.
But are there specific surveys or indicators that carry more weight than others that you look at?
No, I mean I think we've always in the MPC rightly sort of avoided that sort of debate because it means that individual pieces of data get in a sense too much significance, and frankly also I would say it changes over time. I mean the things we look at in the economy, more particularly than others, depend upon the situation. So the labour market at the moment has a very close focus because it is so tight.
Okay, that of course the Bank of England Governor Andrew Bailey. Let's bring in Lizzie Burden right now for the latest. The BOE of course announcing its biggest single rate hike for 33 years yesterday, taking interest rates to a 14-year high of 3%. And for the breakdown then, Lizzie Burden can kind of give us more granular detail on how to assess what the BOE did. What for you were the main takeaways?
Well, the hike itself was priced in, so it was all about the dovish commentary around it. You had a real pushback from the governor against market expectations for the future path for rates. So in other words, saying they don't see rates peaking at 5.25%. And that has an impact for the outlook. So if the market curve were to be followed, you would get an 8-quarter-long recession, not as deep as in the financial crisis, but 500,000 people could lose their jobs. Now, that is bleak, yes, but the bank's saying we don't think that's going to happen. If rates were to stay on hold, the bank would see a 5-quarter-long recession over 6 quarters with a double dip. So the point is, either way, not a soft landing, but the governor refused to be specific about the future path for rates because here we don't do a dot plot like in the US. The reality is, though, it could be even worse than the forecast because the BOE was flying blind here. They don't know what's going to happen on November the 17th, except that we're going to have a fiscal squeeze. Bailey said that there's going to be a lasting effect from the Trussonomics era's policy, and if rates aren't going to go up that much, it has a blowback effect for the pound, of course. So it's very, very different messaging from the Fed, even though it's the same size of hike, and the outlook going forward, pretty bleak. Yeah, and that's really fascinating, isn't it? The divergence from the Fed really points to the economic challenges here in the UK. Thank you for that very uplifting assessment, Lizzie Burden. I was speaking to a senior executive, UK executive, at the Web Summit yesterday in Lisbon. He said, off record, he said, the UK is a complete disaster zone. I mean, it's just like, the views from executives and business leaders here is pretty grim on the outlook. Thank you, Lizzie Burden, of course, covering all things UK for us. Let's bring back in Claudia Pansari, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management. Claudia, there is skepticism amongst some of these markets that the BOE will indeed be able to hold off on more aggressive hikes going forward, given just how entrenched inflation has become. Do you share that skepticism?
I share the skepticism. I mean, I think the BOE is sitting in a very difficult situation of inflation is not income-driven, as in the US. It's not driven by wages. It's driven by commodities and the conflict between Ukraine and Russia. So I think the inflation let's say, relation with the wage and employment market is not the same in the US. So the BOE is still facing a difficult situation, like the ECB in the Eurozone is the same things. It's not wage driven, it's not consumer driven, it's driven by commodity price and supply situation, which is more difficult for central bank to act.
And yet you see value in some UK assets. To what extent is this tied to that energy story we discussed earlier?
Yeah, it's very tight. The FTSE 100 doesn't reflect the UK economy. The FTSE 100 is only having a small exposure to the UK revenues. Only 28% of the FTSE 100 is exposed to the UK, is most exposed to international, is exposed to commodities, exposed to energy, to pharma, consumer staple, all sector we really like. And the valuation is really, really cheap.
Energy, healthcare, consumer staples, you like all of those sectors. Claudia, what are you avoiding?
we are avoiding growth, we are avoiding tech, we are avoiding consumer discretionary, and we are avoiding industrials. All sectors where valuation is pretty high, valuation doesn't reflect the risk of recession, and when the rise in rate and real rates have an impact on multiple expansion. So I think we have changed regime where real rate were negative, nominal at all-time lows. So we now need to revisit the old economy, supported also by inflation. We have seen the earnings season is pointing to the fact that energy is still printing very high earnings, but also consumer staples are having pricing power and are able to pass through the rise in cost. I think this is important to keep in mind as long as inflation remains at such high levels.
The revenge of the old economy. Claudia Pensari, Head of Equity Strategies and Tactical Asset Allocation at UBS Global Wealth Management, with some important insights there. Thank you for coming on this Friday morning. Coming up later, German Chancellor Olaf Scholz. He is in China. He's met with President Xi Jinping. We're going to look at the implications and the complications of the visit. That is next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back. Happy Friday, 25 minutes into your European trading day. Yes, China is proving the catalyst for this risk-on move. You're seeing gains of 0.7% across the benchmark here in Europe, and futures in the US pointing up between 0.4 and 0.5%. Let's get to the Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning. Tech companies are increasingly pausing hiring as they contend with sluggish consumer spending and higher interest rates. Ride-hailing company Lyft is going further, firing more than 1 in 8 of its staff. Amazon says it's holding off on what it calls new incremental hiring, citing an uncertain economy. Even Apple, which has outperformed most of its peers this year, is slowing spending and pausing much of its hiring. Now, Starbucks shares rose in late trading after after it reported quarterly sales that exceeded estimates. The key measure of the same-source sales rose 7% compared with the average analyst estimate of over just 4%. U.S. consumers splashed out more for their lattes amid higher economy-wide inflation. Chinese comparable sales fell 16%, also less bad than feared by Wall Street. And Lenovo's third-quarter earnings climbed 6% on cost reductions and new businesses, even as PC demand suffers an unprecedented slump. The world's largest PC maker told Bloomberg that cost management will be a top priority in the coming quarters. And that's your Bloomberg Business Flash. Tom.
Leanne Gerrans here in London. Thank you very much indeed. Now, come out, we are going to be speaking with Danny Alexander, the AIIB, the Asia Infrastructure Investment Bank, Vice President for Policy and Strategy, and the UK's former Chief Secretary to the Treasury, for his views on China, COP, the shift to renewables, and UK politics. That is next. This is Bloomberg.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in it, just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors? And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
From New York City.
We're in London, in Sydney.
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
How are you thinking about those dynamics?
Welcome back to the Open. We are 30 minutes into the European trading day. Here are your top stories. Reopening rally. Hong Kong stocks head for their best week in over 11 years amid ongoing optimism that COVID measures could ease. In Beijing, Xi Jinping tells Olaf Scholz China and Germany should seek closer ties. Cooling, but how fast? Today's jobs report is expected to show US hiring slowed last month, but will it be enough for the Fed? And SocGen shares surge off the back of better than expected third quarter results as the French lender's fixed income unit sees revenue jump 34%. Let's check in on these markets then as we weigh up these catalysts coming through from China, whether it's progress in terms of auditing Chinese companies that are listed in the US or moves and reporting around maybe some restrictions being eased on airlines. Across the benchmark here in Europe, we're seeing gains of 0.6%. Germany and the DAX up 75 points. The FTSE 100 here certainly gaining on the back of the rally that we've seen in basic resources, up 0.7%. Let's switch it over and see how things are looking in terms of these sectors. Of course, we continue to digest what is happening in the world of central banks as well. Slightly divergent picture between the BOE and the Federal Reserve. It isn't as right now the focus is what's happening in China in terms of the speculation around COVID. And that, again, is playing into basic resources. Top of the list in terms of your sectors this morning. Oil, copper, iron ore, all rallying. Currently, basic resources up 3.3%. Consumer products also up there, gaining more than 2%. Just 4 sectors in the red in what is an otherwise risk-on environment. The dollar is off by 0.4%. Commodities soaring. Futures in the US pointing to gains of between 0.3% and 0.4%. Let's get to what's happening in technology, though. This continues to be a fascinating story, something of a retrenchment. Tech entering into a new phase of austerity. While bumper jobs data showed a strong US labor market despite a cooling economy, tech companies are once again tapping the brakes on hiring, with the sector beset by sluggish consumer spending, higher interest rates, and a strong dollar overseas. There is a bad, there is a bad musk around tech right now. Who writes this stuff? Okay, I'm not blaming Danny. Joining us now is Danny Berger, who's going to break this down for us. Danny, what is happening in technology? They're pulling back, they're freezing. The job squeeze is real.
Yeah, it's an ongoing story. We knew tech was already cutting back, perhaps more so than most sectors, but it's this new reality of the business model needs to change. It's no longer just growth at any cost. So what's an easy or perhaps easier growth lever, cost lever to pull? It is jobs. So you have 2 models here. You have the lowering of the workforce just by attrition. So this is Amazon and Apple. Freezing hiring for Amazon, it's really across the corporate structure. For Apple, it's outside of R&D, or you just go in to straight up cuts. That's what we have from Lyft, cutting 13% of its workforce. It's similar for other tech companies like Chime as well, Open Door, the real estate company. And then, of course, there's Twitter. Kind of weird to put in this bracket because they've obviously got their own thing going on with Elon Musk taking over, but 50% of their workforce is being cut. You have to imagine just with what's going on in tech and a slowdown in advertising, Twitter probably would have had to be looking at job cuts whether or not Elon Musk took over.
Yeah, and you're absolutely right to point to the granularity in this story. Amazon, of course, hired very heavily during the pandemic. Yes. Now they're, of course, having to retrench in some degrees, at least put some pause and break on that. Why are all the job cuts focused in tech right now? How much of that is aligned with the kind of expansion that we saw from Amazon? How much of that was the common theme through the last few years?
It's kind of exactly that, because during COVID, it was tech that grew. It was tech that benefited. People were buying iPhones. They were ordering on Amazon. They were taking lifts. They weren't taking public transportation. And because of that, you got folks like Amazon spending on warehouses. You had people hiring more staff. Stripe, who's doing a round of layoffs, the CEO in a memo to staff laid it out exactly that, saying we just overhired, and saying that they were overly optimistic about where the economy, where the internet-led economy would be in 2022 and 2023. I got the quote up for you here, Tom. So they're now just retrenching. They're having to revisit this. They can't just keep growing like they did during COVID. So yes, tech led on the way up. Now they're leading on the way down. Yeah,
a mea culpa there from one of the co-founders of Stripe. Fantastic stuff, Danny Berger, breaking down what is happening in terms of technology and the squeeze on jobs. Interesting to speak to Kathy Wood as well on the ground at the Web Summit in Lisbon, saying, yes, advertising has been crushed, and that's going to continue to be a pain point as well for technology. Let's check in on some of the individual movers in the session today. We are looking at the likes of Rio Tinto, the miners, on the back of what's happening in basic resources. That ties in to the China story and the optimism around potential softening of restrictions there. Rio Tinto currently up 4.2%. SocGen, we talked about the beat in terms of the third quarter earnings, and certainly investors rewarding that, currently up 4.5%. And Lufthansa were highlighting some of the airlines. Again, the story that Chinese officials are considering easing some of the restrictions in terms of flights to China if they have COVID cases. There was previously pretty harsh treatment. Now they're considering easing some of those restrictions. Lufthansa then, one of the big German carriers, of course, currently 1.8%. Let's move it on and see what is happening in terms of the China markets, because you have had this remarkable run-up in terms of particularly Chinese stocks listed in Hong Kong, but domestic shares have done very well as well. The CSI 300 in the session today up 3.3%. Again, we talked about some of the catalysts that have come through, whether it's the rumors about reopening, whether it's the progress in terms of auditing Chinese companies, or whether it is indeed the easing of some restrictions around airlines. The HS Tech closing up 7.5%. Again, that is home to some of the biggest Chinese tech companies listed in Hong Kong. The Hang Seng Index, that's the benchmark for Hong Kong, up 5.3%. Let's continue with the China story then. Chinese President Xi Jinping welcoming his German counterpart, the German Chancellor, of course, Olaf Scholz, for a one-day trip to Beijing. On the agenda were trade ties and, of course, human rights issues that have strained Beijing's relations with Brussels. We heard from Xi Jinping, according to state media, saying he wants to see Germany and China work together in a challenged environment. Joining us now, I'm very pleased to say, is Danny Alexander, former Chief Secretary to the UK Treasury and Vice President for Policy and Strategy at the Asia Infrastructure Investment Bank, or AIIB, based in Beijing normally. Danny, thank you so much for coming into the studio.
Great to be here with you.
I want to start with this question then, for someone who's spent a considerable amount of time now on the ground in China, working very closely with, of course, your team at the AIIB, but presumably having some contact with Chinese officials. Are we starting to see, post-Party Congress, a third term for Xi Jinping, unprecedented? Are we starting to see a China now, just in the last few days, that is being prepared, is preparing to re-engage once again with the world? As we look at this speculation around the easing of COVID restrictions, the meeting with German Chancellor Olaf Scholz, would that be your analysis, or is it more complicated than that?
It's not really for me to give commentary on the Chinese system, but I think you certainly are seeing some more engagement. That must be a good thing. There are so many challenging issues in this world today, with the multiple economic crises, with tensions around a lot of topics. I think just having countries having the capacity to engage with one another directly, as we've seen with this summit and no doubt many others in the weeks to come, is very important. I'm on my way to COP27 in Egypt, where the countries of the world will be gathering to tackle one of the most important challenges, which is climate change. And for AIB, as a green institution, deploying our capital to support our members, to mobilize the finance necessary to make the green transition, even amid all these other challenges which are on the agenda of world leaders, is a critically important mission.
And I want to go there, and I'll get more of your views on that and what the AIIB is doing in terms of spending around renewables. I know there's been a big shift, but just a little bit more focus on China COVID-0. You and your family clearly impacted by this, as are executives, business leaders who have a footprint, work and operate in China. Do you have any sense in terms of the time frame? What is your gut telling you about when these restrictions may be eased?
Well, I can tell you what I hope for. What I expect may be a bit different. I mean, in the sense that China's clearly still very cautious about opening up its borders and opening up its domestic economy. There's clearly an economic cost to that, but also, they have their own reasons in terms of public health. I suspect we will see a gradual opening over the course of next year, but I wouldn't necessarily hold my breath for a sudden shift on that. But we have seen, quarantine restrictions easing gradually. I will do that when I go back to Beijing in a few weeks' time, and let's hope that progression continues gradually.
And how do you think about the evolution of your bank then, the AIIB, which started off, of course, a lot of criticism from the US and some others. You were involved, of course, much to the chagrin of the Obama administration. But generally, the AIIB is now considered to have met the goals that it set out. But on the other side, China's reputation has plummeted. How hard is it to communicate what your mission is at the AIIB and push back against claims that it's just another arm of the Chinese Communist Party?
Well, I think you're right to say that AIIB has a very strong reputation. The governance standards are very high. We've grown as an institution now from 57 members when we joined, as the UK as one of the founders, to now 105 members on every continent around the world. Our program has grown too. We have $36 billion of investments in 33 different countries, and we have a particular focus on this green agenda that we are discussing. And as a multilateral institution, we're there to deliver the common agenda of all of our members in Asia, in Europe, and beyond. And climate is really a focus that I think brings countries together, even where there are differences perhaps on other topics. And so, we're aiming that at least 50% of our financing will be climate finance by 2025, and that every single one of our projects will be aligned to the Paris Agreement next year. And that will mean that we're deploying finance that's helping the transition, even at a time when there are many, many other challenges facing the world.
And what is that emphasis on funding renewables? What does that look like on the ground? What are the projects that the AIIB is looking at, particularly in which regions?
So we have a strong focus in South and Southeast Asia, as you would imagine. So our largest borrower is India. Other borrowers: Indonesia, Turkey, Pakistan, Bangladesh, and many other countries with smaller portfolios so far. We're investing in renewable energy, in wind and solar, looking at other areas like hydrogen, for example, also. But we're also trying to make investments which help to transform the capital markets to be more receptive to green finance in an Asian context. So projects like Bayfront in Singapore are about trying to transform infrastructure into an investable asset class in the region, because it's not only how we deploy our capital, we want to use our money in a way that helps to mobilize others to a much greater scale, because the climate challenge around the world and in Asia is a multi-trillion-dollar challenge. We'll use our capital to catalyze and to mobilize, as well as to invest in specific good quality projects.
Okay, we're taking live pictures now of Premier Li Keqiang. He won't be in post for very long, alongside German Chancellor Olaf Scholz. They're meeting, of course, after Olaf Scholz met briefly with Chinese President Xi Jinping. I want to, before we let you go, Danny, and I know you're heading off to COP27 Egypt, you talked about the importance of that work. I did want to get your views, of course, on UK politics. If you remove your hat as Vice President of the AIIB, and when you look back at your time as Chief Secretary to the Treasury, you worked, of course, with George Osborne, the Chancellor at the time, as part of that coalition. The current Chancellor, Jeremy Hunt, saying that there are eye-wateringly difficult decisions that are going to have to be made here in the UK. Is austerity 2.0 unavoidable at this point in the UK? Or are there other options? Are there other paths that this nation can go down, given the constraints from the markets?
Well, look, it's not really for me to comment on also current UK politics, tempting as it may seem. But you're right, I've been there. Yeah. Post-2010, we had to make very significant adjustments in response to the global financial crisis. When the coalition government finished in 2015, actually, the UK had good growth prospects, and we could see a more positive future ahead. Unfortunately, the government is back in a position now where it has to make these kind of adjustments. I know Jeremy Hunt from being in the cabinet with him together. I wish him every success with what is an extremely difficult task, and to balance this and do it in a way that is fair and also supports growth is an incredibly difficult task. So it's clear when you listen to the Bank of England and you see the figures that some pretty tough choices are on the way by the government now. How we got there and why we got there is going to be a subject of political debate, and I dare say a major topic when it comes to a general election. But in the meantime, the Treasury has a job to do, and I'm sure that they will do it to the best of their ability.
Danny Alexander, thank you very much indeed. Vice President of the Asia Infrastructure Investment Bank and former Chief Secretary to the UK Treasury, of course. Thank you for coming to the studio. Good luck over in Egypt as well, that important work at COP27. Coming up, one of the world's longest traffic jams is holding up the electric vehicle supply chain. That's today's Big Take. We bring you the story next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Flooding in Pakistan, Hurricane Ian, wildfires in California, drought in Somalia. Just some of the emergencies that will be addressed at this year's COP27 UN Climate Summit in Sharm el-Sheikh, Egypt. But the landscape since COP26 a year ago in Glasgow has shifted dramatically. That's mostly due to the energy crisis sparked by Russian President Vladimir Putin's invasion of Ukraine. The resulting fuel shortages have helped put climate change on the back foot, making it tougher to get governments to follow through on their promises. According to Bloomberg NEF, there is just a 4 in 10 chance of this year's summit becoming a success. Goals had already been slipping. Developed countries committed to giving $100 billion a year by 2020. The OECD now expects that aim will be met 3 years late. Even last year's pledges, such as phasing out fossil fuel subsidies, are struggling. Of the 194 countries that signed the Paris Agreement, just a handful are updating their pledges towards emission reduction targets every year. Now, with political and business leaders gathering in the desert to discuss climate, does Sharm el-Sheikh risk becoming nothing but a giant cop-out?
A look there at what we can expect ahead of COP27 in Egypt. Now joining us is Michele Della Vigna, Head of Energy Industry Research at Goldman Sachs, to continue the theme. But of course, front and center for us this morning is the rally around commodities on the back of the reopening speculation from China. I'm just looking at oil, up 2%, 2.3% for Brent, 2% for WTI. Iron ore is currently up more than 5%. Michele, thank you for joining us in the studio. What do you make of the gains that we're seeing across commodities on the back of this speculation? If we get this confirmed by Chinese officials, it has not been yet, but if we get it confirmed, even if it's gradular, what would that mean for the commodities complex? Are we expecting to see sustained price rises?
I think it's clearly very bullish for the commodity complex, and especially for everything related to transportation and aviation, which is why we believe there's such a bullish construct for crude going to the end of the year. A full China reopening could be an extra 0.5 to 1 million barrels per day of oil demand. At the same time as OPEC is cutting, we're coming to the end of the SPR release in the US, and we've got the Russian sanctions kicking in December, potentially dislocating up to 2.5 million barrels per day of crude. So overall, we would be very bullish crude going into end of year.
And yet the recession risks in the US as the Fed points to a higher terminal rate, the Bank of England suggesting that possibly 8 straight quarters of recession, the Eurozone in a slump. That doesn't derail your calls for higher energy prices?
I don't think it derails it. If you look at the historical sensitivity of oil demand to GDP, it's about 800,000 barrels per day of oil demand for 1% of global GDP. Let's put through a normal recession average for the last 30 years, that's about 1.5 to 2 million barrels per day of demand lost. But on the other side, you could have up to 1 million barrels per day recovery in China, 0.5 to 1 million barrels per day cut from OPEC. SPR ends releasing 1 million barrels per day, and at least for 2 or 3 months, you could see half to 1 million barrels per day of Russian oil being disrupted. So net-net, we see a tightening and not a loosening market, even going into a recession.
And you've talked about the revenge of the old economy, the old carbon economy. We're speaking to UBS strategist there earlier in the show saying energy remains a favourite sector. That is a common theme that we hear from our guests. That is a problem, though, as we look to try and shift to renewables. And you've talked about the divergence in terms of decarbonisation. So what are you seeing in terms of fund flows into those renewables that we need to power that shift?
So there's no doubt that we are severely underinvesting in energy. We actually believe we should invest $1 trillion more per annum if we want affordable energy and a path to net zero carbon. And that's not happening. And this is why we talk about the revenge of the old carbon economy, because what we are seeing is that in absence of policy, and policy would mostly be a global construct for carbon pricing, we see hydrocarbon prices doing the job that carbon isn't doing. And so higher oil, gas, and coal prices ultimately become the way in which the economy decarbonizes. But this is a very disjointed effort that is highly inflationary.
And it becomes politicized as well when you look at the profits of some of the big oil majors, and certainly that's moved up in terms of the top of agenda for many governments and many lawmakers, whether it's a windfall tax or pressure to invest more around renewables. Is that a potential risk if you're looking to get exposure to this sector?
It's certainly a risk, but so far it's been quite marginal in terms of impact on big oil's earnings, because these businesses are so global that unless there is a global construct for a windfall tax, it's very difficult for this to become material. And ultimately, higher returns are required in a world which has high cost of capital on hydrocarbon developments. We estimate that the cost of capital right now for long-term oil developments is as high as 20%. Which is why, despite the high oil price, we're seeing so little increase in global energy investment.
Michele Della Vigna, always brilliant, always fantastic insights. Goldman Sachs, Head of Energy Industry Research. Thank you for coming into the studio this morning on the revenge of this old carbon economy. Brent currently up 2.4%, tying in to that China story. Talking of China, as we head to break, China's Premier Li Keqiang holding a news conference with the German Chancellor Olaf Scholz. That as the country plans to scrap COVID flight suspensions. That is feeding into the optimism that we are seeing in these markets today as well. The Chinese President Xi Jinping has said Germany and China should work together more closely in a challenged world. There is the German Chancellor you can see in Beijing. Stay with us. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The EU is said to be studying the feasibility of using billions of dollars worth of Russian central bank assets to help Ukraine's reconstruction efforts. The discussions are said to be at an early stage, with legal experts looking into possible options. They're focusing on how to seize about $300 billion of assets that were frozen when Moscow invaded its neighbors. Now, former President Donald Trump has sent the strongest signal yet that he plans to run again in 2024. Trump told a pre-election rally in Iowa that he will, quote, very, very, very probably make another White House bid. The former president has used the midterm cycle to reinforce his grip on the Republican Party. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you. We'll go out on what's been happening in the Chinese markets. Closed, of course, after a very solid session on reopening, speculation and some moves there to ease restrictions. Very solid gains in Hong Kong and the mainland. Stay with us. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant. Nobody covers jobs day like Bloomberg.
And I think that's where we are.
There is the potential that we continue to see kind of this re-rack in terms of asset allocation.
There's just a lot more momentum in the U.S. economy.
The Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. You're going to buy the dollar.
The issue for equities, I think, really is down to a hard landing or soft landing. If there's a hard landing, you definitely cannot be bullish on equities.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today.
Today's US jobs report could determine what the Fed does next. A tight labour market has been pushing up wages and inflation, prompting the Fed to raise interest rates further. It's the new era of tech austerity. Lyft is making deep job cuts. Amazon puts some hiring on hold, and Twitter prepares for massive layoffs today. And the stock frenzy in China goes into overdrive. Investors are spurred on by market-friendly headlines and the hopes that the worst could be over. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller. Matt Miller actually off today. Kayleigh Lyons is with me. Chrissy Gupta, of course, also standing in for Matt Miller in New York. And Kayleigh, another day where here in Europe we're seeing the read across from actually what's happening in the Chinese markets and expectation, well-founded or otherwise, around a change in COVID policy, pushing stocks higher.
Yeah, Chinese stocks were on fire overnight, Anna. They were roaring higher because, once again, hope seems to be prevalent that we will see an easing up in COVID zero policy after a report that China may be looking to ease penalties on airlines as it relates to COVID. Plus, you have the additional good news that U.S. audit inspectors are ahead of schedule in their on-site inspections of Chinese companies that are listed here in the U.S. So all of that together collectively giving a huge boost to risk appetite. The Hang Seng China Enterprise Index up 6% on the day, rounding it out its best week since 2015. And the Hang Seng Tech Index up 7.5%, had its best week in its existence. And of course, that optimism is filtering through to other asset classes as well. In foreign exchange, the Chinese yuan strengthening against the U.S. dollar to the 726.81 level. And in commodities, the idea that demand may be recovering in China has lifted iron ore for 4 days in a row, up 5.3% overnight. $86 a ton is where we trade crude. That is the longest winning streak for iron ore going back to July.
Well, certainly something that I think U.S. markets are probably taking